Wow, this bond market over the last month. Live from New York City this morning. Good morning, good morning. This equity market is doing okay, just about positive on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, global bond yields making new highs for the year. As the U.S. economy defies gloomy expectations, the Fed leaves the door wide open for another hike. We begin with the big issue, the ultimate pain trade.
Yields are probably going to be higher for an extended period of time.
U.S. 10-year yields are on their way up.
Yields have been going up.
High for longer.
Direction of travel for yields, in my judgment, is higher.
This range of, 4 to 4.5.
Up above 4%.
This configuration of a 5% Fed funds rate and a 4% 10-year Treasury, I think it's going to be pretty durable.
Closer to 4.5% before we go down lower.
The tendency will be for higher rates.
390 being the low end.
If you believe that the economy, is entering a soft landing, no landing, whatever landing you want to assign to it, that means rates have to move higher, not lower.
Whether 4% is good enough, I don't think so.
We're very bullish on fixed income as well, but you don't have to take a lot of risk in order to be successful.
We are in a different regime.
Regime that we were in pre-pandemic is gone.
I don't think we found the high end of the range.
It's the tendency for rates to be higher that I think most investors are missing.
Rates are high this morning, that's for sure. Joining us now to discuss is Bank of America's Megan Swiber, Neuberger Berman's Eric Knudsen. Megan, wonderful to have you with us again. Back in July, I think you said, and I've got the quote, the larger rate move was ahead of us. Was this the rate move you had in mind?
Jonathan, I think that it's fair to say that the move that we've seen higher in rates has really surprised a lot of investors at this point. And what I think really it's down to is two things. It's the resilience of the U.S. economy, as was kind of mentioned a bit in the open, and also this supply-demand imbalance that we're going to see in the Treasury market that we really see ultimately driving this bear steepening dynamic of the curve.
Let's talk about it, Eric. Is this move over the last month the one you were looking for, given that you were talking about stickier inflation the last time we discussed it?
Yeah, absolutely. Our view is that inflation was coming down, but was stickier than what was going to be stickier than what central banks and generally forecasters were expecting. That was going to lead banks to be, higher for longer. That said, we think the Fed's basically done from here. We do believe that we're trading towards the high end of the range from a 10-year Treasury yield standpoint, but that, it is likely that we will stay higher for longer on yields. The volatility has moved from the short end to the long end, and we think that's probably the single most important factor that we're watching right now is that risk assets trade off long end vol, not short end vol. So this is the move that's really important to watch here, and we think that there can be more long end volatility to come.
I've lent into this question a few times, Eric, over the last few weeks. What is the dominant factor behind the sell-off? Before we work out whether it's durable or not, we have to figure out what's driving it. What do you think's driving it?
Yeah, we think it is that long end volatility. You saw rate volatility was all concentrated in the short end for the last really year and a half, and now the long end is starting to reflect this uncertainty, both in terms of the change in the term premium and the likely need to change the R star or the long term kind of Fed dot. You look at the 25 Fed dots; they range from 2.4 to 5.6, and yet the long-term dot is still at 2.5%. That seems like that needs to change. That would reflect a structural change in the long end of the yield curve. You add in the Bank of Japan, which needs to normalize rates at some point, and that is likely to untether longer portions of the yield curve in the U.S. and globally.
We'll be in Jackson Hole next week, Megan. This is something I imagine they're going to discuss. Do you think that's going to be the center of attention as well, just where that long dot should be?
Yeah, Jonathan, I think it's been really the key focus, as was mentioned, for a lot of market participants at this point. As was mentioned, right, the Fed kind of has in their own projections right now this expectation that they can cut one day back down to 2.5%, 3% on Fed funds. And the market's really questioning that quite a bit at this point. And really, it ultimately comes down to the fact that the Fed has done so much already in terms of delivering those hikes. But yet the U.S. economy has held up so very well, specifically when we're looking at the labor market. So what it ultimately means from here, and I think the Fed is struggling with this balance of risks given the fact that they've delivered, in their view, enough hikes to get to the point where we should be feeling some of these impacts, where they are ultimately restrictive. What they're trying to do now is assess, given the fact that we've seen inflation fall really quite a bit, what are the risks to that inflation outlook when the U.S. economy has been so strong? So I think that at Jackson Hole, there's really going to be two points of focus. It's going to be what is the Fed ultimately looking for to decide how much more, if at all, they need to adjust the overnight Fed funds rate higher. And where are they thinking about where these longer run rates ultimately have to be, which the back end of the curve is really struggling with at this point.
The Jackson Hole get together a week away. Let's talk about the back end of the yield curve right now. The 30-year higher by 5 basis points. The yield at the moment about 440. The 10-year yield higher by 3 or 4 basis points. 6 consecutive days of high yields on a 10-year maturity right there at about 428. Let's call it 430. In the equity market, given what we've seen develop in bonds, we're doing OK in stocks. We're positive here by, let's call it 0.27%, going into the opening bell about 24 minutes away. Yesterday, we had some Fed minutes. Matt Boser is going to join us now to run through it. Matt, just how wide open is that door for another move from this Fed?
Well, I wouldn't say too wide open. Actually, we saw some signs in the minute that there's starting to be some fraying of the consensus around the need for higher rates. You actually had 2 Fed officials that the minute said would have favored actually no increase in July. And so you're starting to see a case building for, potentially an extended pause here. You look at the conversation around the labor market in the minutes, for example, they really see a slowing. They see wage growth coming down. They see job openings coming down. And it looks like they are starting to be pretty happy to accept some of the slowing trends that we're seeing there.
Matt, just how balanced are the risks going forward from here? I picked out this quote. I'm sure you've noticed it too. It was important that the committee's decisions balance the risk of an inadvertent over-tightening of policy against the cost of an insufficient tightening. Matt, what does that mean?
Well, I mean, we've all been waiting for this slowdown in the economy all year, right? And it just hasn't happened yet. So if you look at the minutes, they really are starting to expect that we're going to be seeing that any day now. I think that's the big question. Are we actually going to get that? At this point, the signs are looking pretty good for, continued growth. But that doesn't necessarily translate into higher inflation, given the moderation we're seeing in wage growth, for example, the slowdown in hiring, even as initial claims, right, the layoff side of the picture stays low. So we might be setting ourselves up for a bit of a Goldilocks environment here, dare I say it.
Claims 239 this morning. Not bad. Matt Boser, thank you, Matt. Appreciate it. Neil Dutta of Renmark pushing back against some of this. Take a listen to this line. How can these people possibly know that the stance of policy is in restrictive territory? Neil went on to say this. This is an assumption they're making. I have a difficult time seeing how policy is restrictive when the unemployment rate is low and the economy is growing above trend. Eric, which camp are you in? The Neil Dutta camp or the Fed's?
We're in the camp that the setup is still fairly positive and supportive of risky assets in the short term. And then there is a serious risk that some of these, that higher rates, tightening credit conditions, the general tightness in the economy starts to bite. You look at the short-term positives, particularly in the U.S. economy. GDP now for the third quarter at 5.8%, bottoming in housing, bottoming in manufacturing, consumer spending still strong, consumer, various balances, liquidity balances still strong in the economy. It is expected that earnings are going to, flatten and then even start turning positive from here. So it's hard to kind of stand in the way of risky assets at this point. But we do think that over, whether it's 6 months out or 12 months out, that you are going to have to pay the piper in terms of higher rates and tightening conditions.
Megan, a lot of people have pushed back against this move, and the excuse I often hear from people is that you can't sustain rates above 4%. It's just too difficult. We've had 12 consecutive sessions of closing above 4% on a 10-year yield. What is it about this level that's difficult to sustain, do you think?
Well, Jonathan, I think that it's really, as we were talking about, the impacts of higher interest rates over periods of time, right? And what we're seeing kind of focusing on in terms of risks for later this year into next year is the refinancing risk. So companies that have previously locked in very low borrowing costs, ultimately having to refinance that debt at a much higher interest rate level. And ultimately, our view is that is what can ultimately slow this U.S. economy down. But for now, the Fed has to balance the risks to the outlook right now, given that the data has really been so strong, which leads us to be more so in this higher for longer overnight Fed funds rate camp. And ultimately, we do think that the clearest way to trade this right now is fading the cuts that we see priced into the first half of next year.
How much more can we fade that? What's left of that, Megan, after the move we've seen in the last few weeks?
Yeah, so and indeed we have moved quite a bit, as was also discussed, though a lot of that move has happened in the back end of the curve. I think really that's been sparked by these concerns around where longer term rates may be headed, and ultimately, again, kind of the supply-demand concerns that we see in the Treasury market, given the fact that the government has to be running very high deficits, and ultimately this Goldilocks scenario that we see playing out in the U.S. economy means that the Fed can do QT for a longer period of time. That also puts more supply ultimately into the market, making it harder for the Treasury market to digest this, particularly at this time when people are looking at these 4%, above 4% yields on 10s, 30-year rates, and kind of scratching their heads about whether or not we can continue to move higher at these levels.
Megan, is that what you and the team would say, just to jump in? Was it about that supply move that spooked this Treasury market by the Treasury a couple of weeks back? Not YCC at the BOJ, not the downgrade,
right,
but about Treasury just actually giving us a reality check and telling us how much more bonds they have to issue this quarter?
So I think it really was in part that reality check, but it's really a combination of all of these things, and they really do speak to one another, right? The BOJ yield curve control adjustment ultimately means that foreign investors will not be as inclined to be buying Treasury securities. The fact that the U.S. economy has proven so resilient kind of takes back and pulls back on the asset manager demand that we've seen be very strong in the Treasury market so far. And in terms of the overall supply picture, again, the resiliency of the U.S. economy means that the Fed can do QT for longer, and we can ultimately have more of these supply figures. So I'd say it's kind of a combination of all three of those things together. But I do think that investors are really struggling about what who ultimately is going to be the end buyer of all of these bonds, particularly when we're looking at levels that are going to be well above kind of what we saw fiscal year 21, 22 coming out of the pandemic.
Makes you wonder, Eric, why the equity market is so calm and comfortable with some of this. I know we've had a 2-day slide. I know we're off the highs by a little bit, by a few percentage points over the last few weeks, but it's not dramatic. And this morning we're still positive in the face of yields we haven't seen since 2011.
Yeah, I mean, and look, it's hard to get into a rates debate with a rate strategist. I'm a multi-asset PM, but another element here that is muddying the waters is the very strong level of fiscal spending that's still going on. This is an extraordinarily unusual setup where the central bank is tightening both rates and their balance sheet, and yet fiscal spending is still, very, very strong. It's another source of liquidity, and it's one of the reasons why it appears that short rates have had so little impact on the economy, and why we're so focused on long rates, in this environment. So again, it's in the near term, we just think it's very, very hard to have a very strong directional view at an overall market beta level, given these cross currents and the short-term positives, even with these longer-term negatives out there. And yet there are interesting things to do on the margin. In equities, we want to be biased towards quality stocks. We want to kind of broaden out our exposures so that as the market starts to broaden out, which we think it will over the next 3-6 months, as it has over the last couple months, our portfolios will benefit from that. And there's some interesting opportunities, say, to overweight Japan, underweight Europe, et cetera.
Eric, stick with us alongside Megan, breaking down this bond market and what it means cross-asset and beyond. Equities right now negative, or rather positive, by 0.25%. Treasuries negative, yields up on a 10-year by 3 basis points, 4.28. Let's get you some movers. Here's Abby.
Helping out that positive scene for stocks this morning, John. Cisco shares are popping on a solid quarter. They beat both top and bottom line estimates. Importantly, that means 16% and 42% year-over-year growth, respectively. So this old school tech company growth is back. Apparently, they're making making good headway in AI and security, in addition to their more traditional networking business. Adobe up 2.2%, upgraded over a B of A. Speaking of AI, on their early signs of being an AI leader, now a buy from a neutral. And then Walmart up 0.7%, another top and bottom line beat there, beat earnings by 8%, sales by 1%. They've also raised the earnings outlook for a second quarter in a row. And apparently, John, the strength was grocery, but over the last couple of weeks, they're also seeing a recovery for general merchandise, which could bode well for the current quarter.
Interesting. More on the retailers a little bit later. Abby, thank you. Coming up, the White House growing even more concerned about potential spillover from China.
China made a set of different decisions, and because of that, I would agree that China does present a headwind, not just to the U.S. economy, but to the global economy.
That conversation up next.
China made a set of different decisions, and because of that, I would agree that China does present a headwind, not just to the U.S. economy, but to the global economy. But we're better prepared to deal with that than any other economy in the world because of the policy choices we made here in America that are allowing our economy to grow, us to create jobs while inflation is coming down.
Another warning from the Treasury about the difficulties in China following comments from President Biden, who referred to the economy there as, quote, a ticking time bomb. The currency there under pressure. And according to people familiar with the matter, Chinese authorities telling state-owned banks to step up intervention into the currency market this week in a push to prevent a surge in yuan volatility. Joining us now down in Washington, D.C., Bloomberg's Anne-Marie. MH, what's the latest on this front?
Good morning, John. Well, you see these worries continue to mount in Washington when it comes to the economic concerns surrounding Beijing. The latest being from our interview last night with the Deputy Treasury Secretary Wally Adeyemo. He went a step further than what we heard earlier in the week from Janet Yellen, who said that China and the concerns there are a risk factor to the United States. He said this has to do with the set of policies made by the Chinese government. He still says the U.S. took different set of policy approaches, and that is why they are in better shape, and they should be insulated from this. Both still view this just as a headwind and think the U.S. in its current state will be able to counteract this. But at the same time, you could see that concern starting to rise. And it also comes, as you mentioned, President Biden took a big jab at Beijing, not just saying their economy, Jonathan, is a ticking time bomb, but also saying leaders of the Chinese Communist Party are bad folks. A lot of this rhetoric is going to amp up as we head into the November 2024 election, even as the administration is trying to create a lot more healthy dialogue between Washington and Beijing.
And apparently bad folks do bad things. AMH, thank you. Down in Washington, D.C. Joining us now is Megan Swiber. Eric Knudsen still with us. Eric, I heard this from Ben Laidler of eToro this morning, that China was an economic giant and a financial market minnow. Do I need to worry about the economic giant or just not be concerned with the financial market minnow?
Well, I think that you have to acknowledge the fact that it is an economic giant. We want exposure to China stocks and bonds in our broad global portfolios for both diversification as well as access to growth drivers and what can be, the number of world-class companies. But we're quite cautious on both stock and bond markets right now, given some of the concerns, some of the challenges that China is facing. And the way we're expressing this view is by we have been underweight the currency in our global portfolios. We have been expecting China to come in and take some measures, whether it's to try and stabilize the currency or to provide stimulus. I think that'll provide a short-term pop for the currency. We may take that as an opportunity to add to positions in underweighting Chinese currency, even as we maintain exposure broadly. We are evaluating the potential impacts of weaker growth in China and knock-on effects globally. But where we see the best opportunities in emerging markets is in emerging market debt away from China, where many of the central banks have already raised rates. They're in a position to be able to begin easing rates. We're getting a very attractive yield. We can mitigate a lot of credit risk in those countries, Latin America, some of the other emerging market economies, and that's where we see great opportunities.
We've seen those rate cuts coming through from Brazil, from Chile. Megan, just to finish on that, how are events in China as they develop influencing your thoughts about what happens here in the U.S.?
Yeah, so one thing that we've been really focused on here, John, particularly with regard to China, is the currency issue. Right. So the very sharp appreciation pressures that we've seen on the USD relative to the Chinese renminbi ultimately is driving what we think, and as was mentioned, could be some currency intervention from the PBOC. And while we haven't really seen any notable actions from them yet in terms of selling U.S. Treasury bonds, ultimately that is one way that they can help stem some of the depreciation pressure that they've seen on their currency. We certainly saw this very extreme example in 2015, and that is a risk here. And we've seen a lot of questions from clients and investors this past week come in on the back of that, given the fact that China is such a tremendous holder of Treasury securities. Ultimately, what this means is if they do indeed sell bonds to help defend their currency, is that you could have more upward pressure on the front end of the rate curve, which is still endorsing our view that you want to keep those underweights at the front end of the Treasury curve.
Megan, just to build on that, just a touch, one extra question if I may. Do you think in any way, shape or form,
Please.
what we're seeing take place in Treasuries now is somehow connected to what's happening there?
Well, it's all the same backdrop, right, John? So when we're talking about the supply-demand concern, what we know is that really foreign investors more broadly, when you're talking about the private investors looking at treasuries relative to their own local curves, or the official sector, which is their buying and selling of treasury securities, is very much so determined on dollar pressures. It really paints this picture of a struggled supply-demand backdrop from the Treasury curve. And the way that you see that play out most specifically when we're looking at price action is indeed that bear steepening of the curve. And that is kind of exactly what we've seen play out over the past couple of weeks.
Interesting, particularly the note on currency intervention as well and what could happen with Treasuries. Megan, thank you. Megan Swiber there. Eric Knudsen on the latest. Coming up in the morning calls and later. iCapital's Anastasia Amoroso expecting a challenging month of September to fuel further downside for stocks. That conversation just around the corner.
A
5 minutes away from the opening bound. No drama in this equity market. Drama in the bond market, but stocks okay on the S&P, just slightly positive. That's the price action. Here are some morning calls for you. First up, Bank of America upgrading Adobe to buy. 630 price target, saying the company is emerging as a front runner within the AI race. Next up, Oppenheimer raising its Nvidia price target of 500, expecting the company to benefit from broad and robust AI demand. And finally, Morgan Stanley raising its Cisco price target to 56, seeing signs of improving demand despite the challenging macro environment. That stock is up by 2.4%. Coming up, iCapital's Anastasia Amoroso expecting a rocky September to bring the dip buyers out in force. That conversation up next. Your opening bell just around the corner. Given what is happening in the bond market, I think stocks are doing okay. Given what's happening in the bond market, equity futures just about positive on a two-day losing streak on the S&P 500. Futures here are up by 1/3 on both the S&P and the Nasdaq. Still poised, though, for a third week of losses. There's your opening bell. This is what's happening in the bond market. Yields are higher on a 10-year for a sixth consecutive session, higher by 3 basis points. On a 10-year, 427.81. New highs this morning for 2023 on a 30-year. New highs for the cycle, the decade. You've got to go back to 2011 for yields that high. In the FX market, the euro holding on 109.10 on euro dollar right now, positive 1/3%, and crude holding on as well, $80.60. We're up by 1.5%. One stock to watch at the open is Walmart, raising its annual outlook for a second straight quarter. The CEO saying this: we're in good shape with inventory and like our positioning for the back half of the year. We're gaining market share as our value proposition continues to resonate both for value and convenience. Abby has more. Hey, Abby.
Hey, John. And this is the second quarter in a row where they have raised guidance. So very impressive results from Walmart. In terms of the quarter that they just reported, they beat bottom line estimates by 8%, sales by 1%. These are not small numbers either. They put up revenues of $161 $2.63 billion. That's really pretty incredible. Adjusted earnings of $1.84 per share. And in terms of the outlook that they raised it by a couple percentage points. There was also growth in the quarter that was. Grocery is the main driver for this company, but they're seeing in recent weeks some strength for the general merchandise. So they are somewhat positive. Now, what's interesting, we do have the stock higher, although at this point it's up just about 0.2%. One reason could be the shares really priced for perfection. Coming into today, the stock was up on the year by more than 10%. Its closest competitor, Target, down more than 10%. So investors might have wanted a little bit more, even though this was a very clean quarter and a nice guide.
Abby, thanks for that. This headline from Walmart got my attention, that they see headwinds coming from US student loan repayments, even with this so-called 12-month on-ramp, which basically means you don't have to start paying straight away. Target said something similar yesterday. The CFO said the resumption of student loan repayments would, quote, cause additional pressure on already strained consumer budgets. We're going to catch up with Coward on this in about 10 minutes' time. Look out for that conversation. Let's stick with retail earnings. Tapestry posting weaker than expected results on softening US demand. The CEO touting its recent acquisition of Capri, saying the following: we're establishing a new powerful global house of luxury brands that reaches across consumer segments. Simone has more. Hey, Simone.
Hey, John. Yeah, the parent of Coach and Kate Spade missing on earnings, missing on revenue estimates for the fiscal fourth quarter. That's ended July 1st. But even worse is potentially the outlook for its next fiscal year ending June 30th, 2024. Seeing adjusted earnings per share of $4.10 to $4.15. The street had been looking for $4.22. Seeing revenue of $6.9 billion. That's up 3-4% from the year, but lower than analysts had anticipated. And even this going to be driven by international, the much smaller piece of its business, because the U.S. makes up about 60%, and that is going to be up only slightly, according to management. Now, this doesn't include the impact of that deal that was announced last week. It's expected to close next year to buy Capri, but that's going to be a struggle as well, as the company's going to have to find a way to reduce its leverage ratio. One bright spot, though, and maybe this is what the market is reacting to here, is that it does see high single-digit growth from Asia and China. That is a large part of its international sales and a place where there is potential to sell Michael Kors. That is one of those Capri brands.
That stock is up by 0.8%. Simone Foxman there on the story. Let's stick with earnings. Cisco. The shares are moving higher after delivering results that point to resilient demand. The CEO, Chuck Robbins, focusing on the company's AI potential, saying, quote, this is a huge opportunity for the company. We're laser focused on leading and winning in this space. Ed Ludlow, you know the cheat guide if you're a tech firm. Just mention AI.
Yeah. I mean, the story is AI. The shares for Cisco up 3.8% on an intraday basis. That's the biggest jump going back to February. What Cisco said is that they'll be a leader in AI, but they gave tangible evidence that they're already doing that, saying that they booked $500 million in revenue already for their AI-related products. The broader story is that as the hyperscalers move quickly to add more compute for those firms that are working on large language models, they will need the associated data center networking gear, and in Cisco's case, the software that goes with it. Cisco didn't quantify that, though. There's no sort of like, here's the dollar opportunity for us in AI, but they did give evidence that so far they booked strong sales on it. Remember the other story for Cisco, though, John? They just closed out the fiscal 23 year with 11% year-on-year growth. A lot of that is to do with the component shortages that Cisco experienced through the prior year, and then making up some of that demand that was built up. They were able to get hold of components and sell them. Then it's a different story looking at fiscal 24. We're in the first quarter of their fiscal 24 period, which ends in October. The guidance that we got is that sales will be $57 billion to $58.2 billion in fiscal 24, just shy of the average analyst estimate of $58.3 billion. But if you look at the sell side notes, I think loads of people are quite sanguine about that. 11% growth in the last fiscal year, less than 2% for fiscal 24, but things are normalizing. And something that Chuck Robbins did really sort of effectively is transition Cisco from a kind of legacy tech name that booked sales with big contracts to recurring revenues. Then I go to gross margin on an adjusted basis, 65 to 66% for this current period, above expectations. They're doing well at making money both from the hardware and software components of their business.
I know this is going to be a feature for you guys a little bit later. Look out for Bloomberg Technology with Ed Ludlow and Caroline Hyde. Ed mentioned what was happening on the south side. The stock, by the way, up by close to 3.7%. This is a view from Jefferies. They reiterate their buy after the earnings. They write the following: quarterly results and guidance look solid, particularly in the wake of fears about the organisation would meaningfully cut its outlook for 2024. Their commentary about the macro environment was sensible and incrementally positive. That stock is now higher by, let's call it, 4%. Final story for you. Shares of Hawaiian Electric, they remain sharply lower, falling for an 8th consecutive session after the Wall Street Journal reported that the company is speaking with restructuring firms to address their financial and legal challenges due to the wildfires in Maui. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Hawaiian Electric shares absolutely cratering this morning, currently down about 25% from the bell after, like you said, that Wall Street Journal reporting that the company, the utility company, is in talks with restructuring firms to address the multitude of financial and legal challenges that it's facing. For context, of course, Hawaiian Electric supplies power to the bulk of Hawaii's residents, and as a result, it's facing questions over what role its power equipment played in the Maui wildfires. And now, according to the Wall Street Journal, it's in discussion with whether it needs to hire advisors, given that its legal costs are adding up, just as its access to capital becomes more challenged. Remember, of course, on Tuesday, S&P downgraded Hawaiian Electric to junk status. And needless to say, shares have plunged throughout all of this, currently down more than 70% over the past 8 sessions alone. And today looks downward like we're down another 25%.
That is a tough situation, that's for sure. Katie, thanks for the update. Katie Greifeld there on top of the story. About 7 or 8 minutes into the session, the broader market positive here by 0.25% on the S&P. The Nasdaq just about positive as well by 0.1%, 0.2% higher. iCapital's Anastasia Amoroso expecting stocks to take their cue from 2 key events next week. Unless Nvidia or Jackson Hole save the day next week, there's most likely more downside to go, likely another 3% lower from here. But if we get there, stocks should be a buy, because even though rates are higher, resilient economic growth should offset that. Anastasia Amoroso joins us now. Anastasia, great to catch up with you. Let's start there. Where would be a buy? Where specifically would you look to buy?
Sure, John. Well, the reason I'm looking for about a 3% downdraft from here still is because we now broke through some key moving average levels, the 50-day moving average, and then also the short-term CTA threshold. And if you look at what would be the next sort of reasonable stop for people to step in and potentially buy, it would be a 100-day moving average. And as I mentioned, that's about 3% lower from here. You know, I think that would be a pretty good value given that we've got the S&P that at that point will have corrected by 7 or 8 percentage points. But then I wouldn't just broadly look at the S&P. I would look at some of the semiconductor stocks. I would look at some of the artificial intelligence stocks. And some of them have corrected probably at that point by 15 or 18%. So, you know, given that so many investors probably have wanted to participate this year, but maybe missed that first half rally, I think given anywhere between 10 to 15% pullback on some of those idiosyncratic stories, that would be a great entry point.
What about the race story, Anastasia? I imagine you get asked that question a lot of times. Can we live with 4% on a 10-year, 4.40 on a 30-year?
Yeah, I mean, I actually think we can, because if you think about it, John, you know, what's driving the 10-year is a little bit different than what's driving the 2-year. You know, the 2-year, for the most part, it's all about what the Fed is going to do in terms of rate hikes or rate cuts. And if you think about the 10-year, it's, of course, the level of rates, near-term rates, but it's inflation expectations, and it's also growth expectations. And the reason why the 10-year has been rising and the yield curve has kind of been re-steepening is because we've actually got the third quarter GDP that's apparently on pace for 6%. We'll see if that actually sticks around. But either way, the reason why the 10-year rate is moving higher, part of the reason is because growth expectations are also picking up. And if that's the case, then that's a pretty good offset for stocks that, yes, they have to grapple with a higher level of interest rates. But if that means higher growth, higher top line growth and earnings growth, that offsets it.
Anastasia, you mentioned 2 themes for next week. One was Nvidia. The second event was Jackson Hole. You mentioned it again there. What would you expect to hear from Chairman Powell next week?
Yeah, I don't really think that we're gonna hear a big change in narrative. I mean, if you look at just the theme for next week, Jackson Hole, it's not sort of the what's happening in the economy right now, but what is happening structurally with the global economies. So I think they're likely to take a look at supply-demand imbalances in labor markets, for example, the fiscal stimulus around the world and what that's done structurally to inflation. But these are not going to be kind of near-term policy decisions of what they may do with rates next month. I think the most important event, for that will be the CPI inflation print that we get on September 13th. And I don't think really Fed Chair Powell is going to talk about that, but the FOMC participants should be looking at the last 3 months worth of data. And if you look at the super core inflation on both services and goods, it's annualizing just about zero, on a last 3 months basis. But again, I don't expect that really to come up, Jackson Hole next week, because I think we need to look for September. But really, that leaves the other huge event for next week, and that is NVIDIA. If NVIDIA does deliver, I think it reinvigorates some of the tech stocks, and if it doesn't, obviously that's a catalyst to watch.
Well, they delivered big time last time around. Anastasia, thanks for the update. Anastasia Amoroso there of iCapital on this equity market. We are about 12 minutes into the session. Equities are doing okay, positive by 0.25%. Coming up, Walmart lifting its outlook for a second straight quarter.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and they really are getting the profitability they need to drop to the bottom line.
We'll be breaking down the results with Cowen's Oliver Chen. That conversation up next.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and they really are getting the profitability they need to drop to the bottom line. It just seems that the consumer has been more resilient than I think a lot of us have given credit at this point in the year.
Big time. I think we all agree on that. That was Telsey Advisory's Joe Feldman reacting to Walmart's latest earnings report. The retailer topping Q2 estimates and raising its outlook for a second consecutive quarter. The CFO saying this: we had another strong quarter. Around the world, our customers and members are prioritizing value and convenience. Bloomberg's John Edwards joins us now to discuss. John, I was talking about this earlier on this morning. If the earnings are good for Walmart, what about everyone else?
Yeah, well, Walmart is taking share from a lot of its competitors, and so it's not, Walmart's success is not necessarily raising other boats, but what we're seeing is, they continue to be in sort of a sweet spot here where they are appealing to the value conscious, sort of lower and middle income shoppers, but also getting people, from upper income categories who are trading down and finding that they're appreciating the selection and the values at Walmart there. So, it's an interesting situation, too, in that, they did raise their outlook, but it's a little bit of a backward-looking raise, if that makes any sense, because they continue to be cautious about the balance of the year. They're saying that, the increase in the outlook is basically because they've done so well that they had to increase the numbers for the full year. But they're still making some cautious noises about how consumers are going to hold up in this quarter and the next. So we'll see how that goes.
Flagging student loan repayments as well. I saw the same thing. John Edwards there on the latest. Yeah, John, thank you. The stock is up by 0.7%. Cowen's Oliver Chen weighing in on Walmart's results, saying this: Walmart was impressive with stronger results in general merchandise relative to prior expectations. Overall, health and wellness continues to lead comp sales. He maintains an outperform rating and 180 price target. Oliver, I'm pleased to say, joins us right now. Oliver, how about that? And good morning to you, sir. What do you make of the guidance? And how many headwinds are out there going into the end of the year?
Yeah, we're excited for the beat and raise. It was an all-around good performance from Walmart. What's really working here is grocery as well as everyday low value. The grocery comps were up high single digit. It's been a much tougher situation for Target. As we've mentioned, consumer discretionary at large is under pressure. Target is much more exposed to consumer discretionary, and consumer discretionary trends were a little bit weak at Walmart as well, but we're impressed with what they delivered here this quarter. The consumers are looking for value. They're being choiceful. They do have spending power, but as you mentioned, student loan exposure, it's about 17% based on our survey work at Walmart and 20% at Target. That being said, there is a 1-year grace period from which some of the student loans won't damage your credit in terms of the grace period. So that's something to watch as well, John.
Oliver, I was thinking about the same thing. There's a 12-month on-ramp. How do they know? Yeah. This feels like an excuse in the oven for 3Q. Is that what it feels like for you? Just lower the bar a little bit.
Yeah, I think the cautious optimism, they are expecting a decelerating revenue growth in the back half. Our take is that could be very conservative. What we see in the numbers at Walmart is pretty balanced performance from traffic and ticket. Having positive traffic is very good. The comments on back to school at both have been very constructive as well. So as long as Walmart plans for everyday low prices, which they do very, very consistently, that's a key positive. Second point, they're getting higher income consumers. That's a key positive. They're also very focused on convenience. Think about curbside pickup. Think about ordering online. You don't even have to go into the Walmart store to really benefit from this entire ecosystem. The other important point, John, is this digital revolution. So Walmart CEO mentioned artificial intelligence and generative AI. That will play a big role in the future of retail. And we've done a lot of work on computer vision, specifically inventory management and inventory recognition. It's all happening in retail right now.
Oliver, you mentioned the high-income groups trading down. Can we just sit there for a moment? We've seen weakness in luxury in North America. We know there was a luxury watch boom through the pandemic. That's fading pretty quickly. Oliver, what's happening with the high-income groups in America, that high-income consumer?
Yeah, the high-income consumer is seeing cross currents, specifically the aspirational consumer. In terms of that consumer that's shopping for entry-level luxury, that's a little bit weaker. And even though the Tapestry numbers, North America has been tougher. So that is something to watch. Also, John, everybody's traveling, so that's taking share away from tangible goods. On the other hand, we're seeing still solid results from Asia and China in most categories, so that's quite a positive. And at the very high end, that consumer always has a lot of money, so it becomes quite emotional. The very high end remains very strong, and some incredible price raises at Hermes, Brunello Cucinelli, Chanel. That high end is working quite well. So a mixed picture, but overall, luxury goods is a great place to be. As you know, my top stock ideas are Louis Vuitton, as well as Costco and Walmart, thinking about that barbell at the high end and customers looking for extreme value as well. And Costco has a higher income customer too.
That weakness in North America, I saw it in Richemont numbers. I think I saw it from LVMH as well. Oliver, do you think that changes as we loosen up some of the travel rules around group tours from places like China to the US, to the UK? Does that change things for the US and North America?
We're hopeful, but regarding China and travel, visa restraints will be a limiter in terms of that. And also, it will be slow and phased in. In terms of the Chinese tourism, John, it will happen most close to China in terms of Japan and Korea. That's happening now, and a little bit later to Europe and the US. But that is a longer term opportunity. In the near term, we are still cautious on this U.S. consumer, the aspirational consumer. Inflation is distracting to everybody, and that's taking money away from other purchases, as well as consumers going out again. There are bright spots such as beauty, health and wellness. Those have been great categories, and they're very consistent with going out. Thinking about cosmetics and investing in your face is very important.
An LVMH Walmart barbell. Oliver, thank you. I agree. Investing in your face is very important. Thank you. Oliver Chen, thank you very much on the latest. I didn't miss that. 23 minutes into the session. Equity's just about positive with some sector price action. Here's Abby.
Hey, John, it's going to be interesting to see whether or not we have another bearish reversal on the day because we are off the highs. But to your point, a small gain here for the S&P 500. So not surprisingly, more sectors are higher. Energy leading the way, up 1.9%. Materials, communication services also up there. To the downside, though, we're looking at healthcare, consumer discretionary, and tech. As for that energy strength, it really is pretty impressive, up 1.9%. And we have both ExxonMobil and Chevron participating. I believe this sector, John, is higher on the year. I will have to confirm that another time, but it really a comeback for the energy sector.
You can check in a break. Abby, thank you. Your trading diary up next. "26 minutes into the session, we're just about positive on the S&P 500. That's the price action. Here's the trading diary. More earnings coming up later. Deer earnings coming before the opening bell on Friday, plus another read on the consumer with Estee Lauder numbers as well. We round out the week with Eurozone CPI on the data front next week. Just a sneak peek of next week for you. The president heading to Hawaii to assess the damage in Maui. And finally, you'll get the Jackson Hole Summit, the get-together for the Federal Reserve next week as well. Full coverage coming from us, and that first Republican debate in the mix too. So busy week next week. From New York, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.